friend, but more importantly, my real estate investment partner, Natasha Falconi.
Awesome. Why do you do that, Beth? You're gonna ruin my makeup. Okay, guys, so I'm here to motivate you to invest in real estate. And that's what the conference is all about, but more on the technical side. So we're gonna review an OM. Does everybody know, or who knows what an OM is? That is fabulous. So for those of you that don't, an OM is an offering memorandum. You know, I understand what everybody means when they're running up here. I'm like, wait, all these ladies work out, why are they winded? Okay, I need a second. Okay, so an OM is an offering memorandum. And what that is basically the document that you review in order to decide if you're going to invest in a property, any property. And the OM has certain elements in it that you want to pay attention to. There's a bunch of things. Like if you were to talk to Sarah, Sarah will give you a list of 100 things, right, Sarah? I'm only going to talk about 10 items that really, I think, give you a good indication of whether you should consider an opportunity or not. Now, with that being said, you need to keep in mind your personal goals when you're reviewing an OM. Because there are a lot of great opportunities out there, but think about yourself, your personal goals. Do you need immediate or want or need immediate cash flow? Are you looking for growth? Are you looking for both? So when you're reviewing an OM, you want to keep those things in mind because the opportunity needs to match what you want. So when reviewing an OM, you want the information to be clear, concise, and you want to just be able to understand it. Some OMs are 100 pages, some OMs are 15 pages, and what you really want out of that is for you to be able to understand what it is. So, the investment summary. Every OM has an investment summary, which is usually like a little box on a little square on the first or second page that tells you what is in the rest of the document. The returns that you're going to receive, the purchase price of the property, the loan that's going to be acquired, what you can expect as far as preferred returns to the investors, the holding term, the financing terms, but it's a very short summary. You want to review that first and say, okay, this looks good. There's an 8% preferred return. Yeah, that meets my criteria. You keep moving. Also the strategy. It usually includes a summary of the strategy. Long-term hold, short-term hold, and that's, like I mentioned in the beginning, what is your strategy and does it match what you're reviewing? So you can look at an offering memorandum, look at the investment summary, and stop there if it doesn't match your criteria and move on. Or if it matches your criteria, then we keep deep diving. So next, this one is, well, they're all important. And I want to say that they're not in any particular order, but I would say the first thing you want to do is know the GP. I think we heard it. It was sprinkled in many of the conversations throughout the day yesterday, but know your GP. And what do I mean by that? Who are they? How did you meet them? Do you know anybody that's invested with them? Beth likes to say, do you know anyone that's no longer investing with them? And have a conversation with them. Do you know what their strategy is, how they think? Understand and meet and learn about the person. Are they available for questions? Can you just call them? Will they answer your emails? What is their strategy? So it's like all these things, just what do you know about the person and how does it match what your values are as well? You want to know all of that because when things are great, they're great. When things are not, you want to be invested with the right person. And what was said yesterday about the horse and the jockey, that is everything in reference to an opportunity because although investments are risky, even though you have good feelings about, you know that it's a strong opportunity, at the end of the day, investing is investing. And if the right person is running the opportunity, then you have a greater chance of when something goes wrong, knowing that it could be good. So, understanding the financial projections. I know this is when many people shut down and say, okay, I don't do math, I'm not a CPA, I'm not an accountant, I don't know. None of that matters. You don't need to be. You need to understand certain elements, and then if you decide that you want to invest, you can always ask somebody, you can always call somebody. You can call me, I can walk you through it. But you do have a responsibility to understand the general elements. And what does understanding the financial projections mean? What is the cash flow? Is it cash flowing year one or not? If it's not, why? For example, the properties I buy don't cash flow year one because I buy underperforming assets. So that's a given up front. But the cash flow, even though the cash flow is not performing year one, the preferred return is still due to the investor. You're just not going to get it in year one because we need to fix the property. So you know that upfront that that's the case. In other situations, it's not like that. The point is understand it and know it. So I said, you don't need to be an expert. And so what is the calculation for future growth? Many times, and you see in many OMs, that you'll say, okay, rents, you'll see, and I'm gonna show you in my breakout, I'm gonna show you two OMs, a commercial one of Beth's and one of mine. So you'll actually see the document. But when you're calculating returns, many people will say, or many OMs will show, okay, I have a 5% increase per rent for 10 years, or I have whatever the number is. Take a look at those figures and see, well, is this realistic? Is this realistic considering where the market is today? And what is it that they're using as a cap rate to say what the end is going to be, meaning when we sell the property, what it's going to be? Does everybody know what a cap rate is? Yes, I see, okay. So understand, no? Okay, I knew you were going to do that. So when you do a projection, you create a projection and you say, okay, rents are this right now, and again, they're projections, so we're guessing what's going to happen in the future. We're going to increase rents by 5% a year, we're going to increase expenses by whatever percentage a year, and at the end of, let's just say 10 years, the value of the property is now X based on income because we value properties based on net income. And then you're going to apply a cap rate, which is the interest that the investment is worth. So, or what the market is calling for at the time, I should correct that. What the market is calling for at the time. So if you divide that number by, use 5%, 7%, that's the value of your property at that time. I hope that was clear. I lost my train of thought. Okay. One thing to look at in reference when you're looking at the financials. So I talked about increase in rents. I saw recently an offering memorandum where they underwrote late fees. So late fees were included in income for the property. And it was increased by 5% a year for 7 years or 10 years or whatever it may be. Well, that's a red flag. Because if you have late fees, great, but take that out. Because if you're underwriting late fees, that means that you're actually planning on having pretty crappy tenants in your property for 10 years, And you're not taking into account what it costs to actually deal with that. So those are the little nuances to pay attention to when you're looking at financial projections. So it's more, I would say, logic than knowing accounting. So pay attention to those things. Risk factors. You can list a bunch of risk factors, but what are like 4 that stand out? The market. So in multifamily, I'll use multifamily as an example. What's being built? How does it match to the asset that you're purchasing? What is coming in the pipeline? What's happening around you so that you can decide if that's a good asset to invest in? The actual property, how old is it? What's going on with the property? What are the unknowns? And then when I said that, that was like, I laughed. I'm like, well, if I knew the unknowns, it wouldn't be an unknown, right? But if you've bought or invested in that type of property before, you kind of have, or if the sponsor has, you can ask the question, well, what has happened in the past that you didn't know? It happened to me, actually. We had an unknown in the property that we're going to visit today, and I never accounted for this. There was, and I'll show you guys when we're there, but there was water coming in to the second floor units. It was raining inside of one of the second floor units, and I'm like, that's impossible because it should come from the roof and not from the floor. Well, there was water penetration, and we had to deal with it. Never in a million years would I have guessed that that was an unknown. Guess what? You know what's happening in the next property? Now that's on my list of things to have to look for. So experience has your experience is what unknowns, you can kind of start checking them off the list, if you will. Your sponsor can. And those are the questions that you should ask. But what are the things that are not accounted for here that maybe could happen in the future? Financial. I would say the biggest risk factor in reference to financial right now is interest rates. So we have that example where all these deals have been purchased for 2, 3, 4%, and geniuses in reference, but everybody forgot to fix their rates. So now they're at 7, 6, 7, 8, 9, and deals are upside down. So something to pay attention to as well when you're looking at the offering memorandum is, so what's the interest rate? And is it fixed? And if it's not, how are we addressing that when it comes up? Because we don't know what's gonna happen. We were buying properties at 7, 8, 6, 7, 8, not long ago. But when we got to 2, 3, 4, everybody got excited and we forgot about what happened in the past, and now we're back to where we were. So take a look at it, not only focus on where we are right now, but make sure that if this is a property that is gonna be a long-term hold, that you're paying attention to what's gonna happen if we have to refinance, and that it's being accounted for. It's not bad that interest rates go up. You just need to account for it and make sure that the numbers make sense. And then operationally, the risk factors operationally are basically who's running the day-to-day of the opportunity. If we're talking about shopping centers, do they know how to do leasing? If something happens, do they have the resources and the relationships to actually make it happen? If it's multifamily, what have they done? How do they treat their tenants? How do they actually perform in reference to dealing with issues with the property? You want to know those things as well, because that will make a difference in an opportunity moving forward on how well it performs when you get to year 5, 6, 7, or 10, depending on how long the hold period is of the property. Fees. I think we've been talking about that the last few days in reference to fees. We learned that some of us don't charge any fees, and then others do, right? So there's no wrong answer. Fees are not good and not bad. They just are, and you have to make sure that if they are in the deal, if they are in the opportunity, that you know what they are. There are many that charge fees, and they do not bring them up, and they're not in the OM. And actually, Beth told a story, and I don't know if she said it here, but she was on a call, and a Zoom call, and she said, "Oh, so what are the fees?" And the squirrels. There's no fees. What? Fees? What? That's not something that you want to know, I guess is my point. You want to know. And what are the fees? There's acquisition fees, there's property management fees, there's disposition fees, there's financing fees, there's guarantee fees, and the list goes on and on. So know them, ask about them, and invest with individuals that will share it with you. If you don't like the fact that there are fees, then just don't invest in the deal. Or accept the fees and know that they're part of the underwriting. So just understand what they are. I guess the main point of number 5 is transparency. So we talked about the GP in the beginning. You want to know who they are. When we're talking about numbers and money, and when we're talking about dollars, make sure that you have transparency. Is the GP investing in the project? You want the GP to have skin in the game along with you. And so not only are they investing their fee, many times, well, not many times, always, usually, there's an acquisition fee or other fees that the general partners receive, and they put it into the deal. My school of thought is that the GP needs to have skin in the game along with the LPs. They should invest their own money, because then you know that they're really aligned. In some cases, that's not what happens, and there's reasons for that, and then you make the decision on if that opportunity works for you or not. But I believe that when a GP invests alongside the LPs, they just look at the deal not only for the fees, but for the investment. Reporting. Every GP or every sponsor does it differently. Some do it monthly, some do it quarterly. You just need to know. Again, I would say in all these slides, with the exception of knowing the GP, there's no right or wrong answer to how it should be. You just need to know what the commitment is and make sure that they're keeping their commitment. If it's monthly and you're okay with that, it's monthly. If it's quarterly and you're okay with that, then that's fine too. But just know. And then along with the reporting, if you have questions, are they responding to you? So once you receive reports, are you able to communicate with them? And we talked a little bit about that at the beginning, but they go hand in hand. Make sure that you know when you should be expecting the reporting and that they're going to meet their commitments. When should you expect distributions? It's aligned with reporting from a commitment perspective. It should state in the OM when the first distribution is going to happen. For example, in my opportunities, they don't happen until the first quarter of the second year because of what I mentioned earlier. But you know, it's in the OM and you know up front that you will not be receiving distributions in year one. Some opportunities are different because they're not value add and you should potentially receive distributions in the first quarter. So look at the OM and review it also with that lens and see, okay, so this is what the projections look like. Should I be receiving it? What are they projecting that's going to happen? And then at that point, you make a decision. And I want to mention something. I saw on Twitter, there's a gentleman named Alex that posts all the time about LPs and GPs. And they say, if you ever see an OM that says, guaranteed distribution, run for the hills. Because nothing is guaranteed. We underwrite it. We put it in the OM. It's what we expect to happen, but nothing is guaranteed. So you need to also remember that although you trust a sponsor, you know that more than likely what we say is going to happen is going to happen, there's always a chance that it won't. And you have to keep that in mind when you're reviewing the OM. But guaranteed is not a thing in this arena or in this. So, oh, did I skip one? Understanding the subscription agreement. This is painful. Super painful because there are 1,000 pages, there's a lot of legal language, but you need to understand it. You need to understand what your rights are as a limited partner. You need to understand your obligations. You need to understand capital calls if they occur. What happens if is there a capital call? Do you get diluted? What does the document say? Understand distributions, even though it's in the OM. It might not be as specific, or it may be, but understand the legal document. That's the point. We heard that yesterday from Sarah. Understand the legal document. Can you transfer interest? And what are the capabilities of the GP? So what can they do with it? What can they do without your authority? You just need to know. And those are just a few that I'm mentioning just to get you thinking. So read the document. And last, what is the exit strategy? We talked in the beginning about thinking about what your strategy is in reference to investing. Do you want cash flow? Do you want equity growth? Do you want quick flips? Again, there's no right or wrong answer. It's what works for you. For example, our properties, I want to hold them forever. So I analyze our properties 7 to 10 years. If somebody gives us a Godfather offer, we might take it. But really, we are not, we're not for sale. We're building legacy wealth. And I believe that from our perspective, equity is how you build legacy growth. But it's not wrong if somebody wants to buy a property and sell it in year 5. That also accomplishes, it's different, but it accomplishes the same, maybe not legacy growth, but it provides income. So know what the exit strategy is, what's in the document, and what's on the OM. So those are the 10 things that I kind of focus on when I am looking at an OM investing passively in other deals. What's the most important thing of all? Trust the person's good, making money, I heard. Get started, ladies! Thank you, everybody.
Let's give her a round of applause.